Hey, we're talking about raising equity for your first deal in this business video. And I can tell you from firsthand experience that most people get this categorically wrong. They don't think about the equity quickly enough. When they do, they don't value the value of equity quickly enough. And as a byproduct of those first two items, they don't get the deal done and they never even get started. So here's the thing, firstly, if you're trying to buy your first business, probably you're thinking about the long term. And if you're not, that's a whole other conversation, but I would urge you to think for the long term for a few reasons, right? Firstly, if you're gonna buy a business, you wanna set it up to be successful for the medium to long term. And for a host of reasons, obviously you want equity expansion, you obviously want it to be successful, you don't wanna go bankrupt. More importantly though, is businesses don't buy and sell like stocks. So if you're gonna buy a business in the first place, you have to make sure that the way you're buying it can stand the test of time. And if you look to exclusively buy a business using debt, you're gonna really put yourself into a difficult spot because obviously debt requires you to make a payment every single month. Secondarily, once you buy your first business, the debt markets are not gonna be favorable to you. You already have a first lien on the business, which means your primary lender already has all the rights to the collateral for that acquisition, which means secondary lenders are not gonna wanna finance working capital unless if you're just crushing it, right? And it's gonna be a lot easier to crush it if you're not burdened with debt. So for a host of reasons, the equity in your deal is super important. So now let's talk about raising it, right? Now you heard me hit on two really important points at the very beginning of the video, which is number one, most people don't think about equity soon enough. They don't start building relationships with investors early enough in their acquisition process. And then secondarily, they don't value the equity enough, which ultimately in my mind, and I've seen this from firsthand experience working with people in years past, means they don't want to give enough equity away in their deal. They're stingy. The first big thing here is don't be stingy. Now, I get trying not to dilute yourself at the top co level. If you don't understand what I mean by top co, I mean basically the holding company. I get not wanting to dilute there, but absolutely you should be looking to dilute, which means give away equity at the deal basis, at the subsidiary level. So that's number one, give away equity. Give away as much equity as you reasonably can to get, excuse the wind, they're blowing my little makeshift tripod. Give away as much equity as you can while still keeping the control of the deal and without bringing your investor in to personally guarantee in dodgy places that they probably don't want to. Okay, just that right there, those two premises, the idea of one, you have to start building relationships with investors well before you need the money. And the way I always used to explain this to clients when I had them was to talk about narrating the deal to investors, giving them updates on a regular basis about who you are, what you're looking for, what deals you've analyzed, why you've passed on those deals. I can't emphasize highly enough how important that is to talk to investors about the deals you've looked at and those deals that you've passed on. Why is that so important and why is that so powerful? Well, firstly, when you reach out to investors well in advance, you give them your premise or your pitch about, hey, here's who I am, here's what I'm looking to do, here's the markets we want to make acquisitions in, here's how we're going to fund these deals using a combination of, say, SBA finance, second position seller finance, and some equity. And that's why I'm talking to you. This is the geography of the deals we're looking at. This is the size of the deal we're looking at. We're looking for businesses that serve commercial clients or residential clients or who have a mix, or we're open to either side. This is the deal team that I've put together, hopefully with an industry expert that's going to help me make sure that I know my way around the river bend. Or, if you have, industry experience yourself, then you're obviously going to speak to that. Hey, I've been in this business, in this industry for the last 20 years, you have to have the credibility pre-established. I've talked about this a bunch on the YouTube channel and on my social media platforms for years now. So, watch the other videos for more of that content. But ultimately, this is all kind of presupposing you've established yourself a decent foundation with the right deal team, right? So then once you have, now it's about building that relationship with the investor well before you ever ask. Nothing is more repulsive than going to somebody and saying, hey, nice to meet you. I'd like you to invest $250,000. You don't know my name yet. You don't know why I need the money. You don't know why I'm trustworthy. You don't know anything about me, but I want you to invest $250,000 into this deal. You're not going to get very far with that. You're going to be spamming the marketplace, and you don't want to do that. You want your reputation to hold water and to hold weight, and you want, when the call comes in, for somebody to want to answer that call and to talk to you and to hear what you have to say and to give you the time of day. And again, the way you do that is by introducing yourself well in advance, making it very clear that you're not asking for money today, you're not asking for money tomorrow, you don't plan on asking for their money probably in 3 or maybe even 6 months. But when the time comes and I find a deal that looks like this, that's valued like this, that's in this market with these characteristics, then this is the kind of deal I want to put together, and here's how I'd plan on financing it. Now, that's the initial conversation. From there, update the investor, I'd say about once a month. Preferably on a phone call, a little 15-minute phone call, but email works or text message works. I mean, you could shoot them a quick video, though I would probably put it in writing if you're not going to pick up the phone and talk to them outright. But those monthly updates are huge. Why are they huge? Because it keeps you, A, top of mind, B, it shows you're doing the work, you're out there actually turning over rocks, looking at deals. And tertiarily, each time that you update them and give updates about the deals you've looked at and the deals you've passed on, what you are really demonstrating without saying it outright is you're demonstrating prudence, pragmatism, a willingness to pass on things and to not be overexcited, and that ultimately you have enough patience, which is really important, right? Because an investor is going to want to invest in somebody who's discerning and who doesn't just jump at the first thing they see, right? Super important. Okay, so you give these updates, you give these updates, you give these updates. Finally, now you find a deal you really like, and you've been giving updates to a handful of investors, or hopefully a few dozen investors for 6 months or more. Quick time out as well. Where are we going to find these investors? Tons of places. I mean, you could be spending time in country clubs or in high-end establishments, right? You can obviously build your network that way. If you build a deal team, you can leverage off their network. If you have an attorney on your team, he or she probably knows people who have money, who are accredited investors. Same with your accountant in theory. If you have a great industry expert, they may have those relationships as well. There's obviously conferences and things you can go to. It's more common than ever now for searchers to be looking for deals and for people to be coming to those conferences or conventions, if you will, who have money, who basically run a ride on the coattails of searchers or people who are actually out there finding deals, right? So you can do that. Tons of people that you can connect with on X, aka Twitter, and if you're updating and sharing your story on X or on social media, like the way I did, you can go back and watch my videos from 5-6 years ago. I was telling my story in real time, and what a concept. I had people who wanted to invest in me before I even did a deal because I was narrating the process exactly the way I'm talking about doing in this video. So there's a host of ways you can find investors. You got to be a bit creative. LinkedIn's changed over the years. You got to get the recruiter package or the sales, plus package. It's about $100 a month, to give you more outreach capacity. But again, when you reach out, it's about not asking for the money now, simply asking for the opportunity to build that relationship. All right, so once you finally find the deal, this should be a different kind of a conversation, because up and leading to this point, you've been telling them all the reasons why you've passed on deals, why you've not jumped on it. Now it's about, hey, after all of that patience and prudence that our deal team and I have demonstrated over the prior 6 months, now we have a deal that's hot. These are the reasons why, A, B, C, D, E, F, G, da-da-da-da-da-da. And then it's about how much are we looking for as far as the equity raise, right? Now, the big thing I can talk about, and I referenced it prior, is give more than you may want to. Keep the majority ownership, keep the majority control, but give equity, give away equity. Why? Because it's about getting momentum so that you can get the deal done, which establishes your credibility to go on and do more deals and or to build this company to be bigger and more successful in the years to come, right? You're not going to get wealthy by just buying a business. You're going to get wealthy by owning it for many years to come, growing it for many years to come, and by buying more businesses in future years to come. So doing your first business acquisition is a setup move for all the opportunities that it can provide in the following years. So that's the first big reason why you want to give away equity, is because you need to whet the appetite a bit, because you're a first-time business buyer, and people are always going to have some skepticism. By giving away more equity than you need to, you're going to give them that interest to go forth. So what is more equity than you need to? Well, let's say you have a $1 million business acquisition, or you're looking for a $100,000 investment. Standard, would be that 100 grand goes into $1 million 10 times. So in theory, that would be 10% equity, would be a standard investment, we could say. Fair enough. But what we're talking about here is a step up in basis, or what I used to call an equity arbitrage. And by that, I would say, hey, if you put in 100 grand for this $1 million business, hey, Mr. Investor, standard would be, that'd be a 10% ownership, but I'd like to offer you a 15 or a 17% or an 18% ownership in this business for that $100,000 check. Now, I didn't go up to 20 there, because if it's an SBA financing that you're doing, which is possible, especially here in the US, then anything at or above 20% is going to require them to personally guarantee on the SBA loan, which they're not going to want to do. So assuming you're using SBA financing, you basically want to give as much equity as you can while you keep the majority of the ownership without them having to get to the point where now they are actually personally guaranteeing the loan, which again, they're not going to want to do. But this is a step up in basis or an equity arbitrage. The financiers use a step up in basis as kind of the parlance. I used an equity arbitrage and still do because it's an arbitrage in their favor. But that's really what you're looking to do. I mean, now on the legal front, I'm not an attorney, of course, so this is just foo-foo for thought, but roll with me here, is you're gonna want a subscription agreement. That's where you subscribe the equity to your entity, the entity that's ostensibly gonna be buying this business acquisition. An attorney is usually gonna have this investor agree to these representations that basically share that, hey, there's risk here, hey, there's no guarantees here, hey, this is an investment, you acknowledge that you are capable of analyzing risk and that you understand that there's some risk and that you're willing to sign up into this deal. You're gonna want them to sign something like that. And then you're going to subscribe this equity to the entity that's buying this business, and your attorney can help you put that together. But that's ultimately how you're gonna bring this thing to life. In a nutshell, that's it. Meet people and talk to people and introduce you and your deal team and your premise well in advance. And then when the time comes, don't be stingy, be a bit more giving. I know it goes against your interest of thinking, man, I did all this sweat equity, all this labor, all this work, I wanna own it myself. But I've seen countless people who are too greedy in that moment in time and who don't plant enough seeds and meet enough investors well enough in advance, and then they find an interesting deal, but they can't get it done because they didn't set themselves up correctly. You know, and in contrast, I've bought 7 businesses now over the last 5.5 or so years, 6 years, whatever it is. And while it hasn't been perfect, those businesses by and large have grown, or in some cases they've been merged to build more competitive businesses and larger businesses. They've been amalgamated into a portfolio now, a pretty meaningful portfolio, especially with Bright Utilities. And these are things that can happen when you build that momentum. But you can't build momentum if you don't go from 0 to 1. By definition, that which is at rest stays at rest. That which is in motion stays in motion. You have to get in motion, and that's why it's so important to find the equity and to be generous enough to get somebody to invest in you so you can get the deal done and so that you can grow on from there. All right, if you've liked this video, subscribe, thumbs the thing up, and I'll talk to you soon. See ya. Peace.